Ever been in an audit exam, written an answer you were sure was solid, only to get your paper back and see you've lost marks, and you have no idea why? It happens to the best of us. Well, there's a secret language that ICAI uses, a framework for how they want you to think. And if you don't speak that language, you're just throwing marks away. Today, we are going to crack that code. Let's start with a scenario you will almost certainly face.
All right, so picture this. You've got a balance sheet in front of you. You see that line item, inventories, 5 crores. Now, what do? What's your first thought? What do you actually check? Do you just look at the total? Maybe double check the math? What is the examiner really looking for here?
If your gut reaction is to write something like, I'll check the inventory records and count the stock, well, that's not wrong, but it's not the full answer either. And that's exactly where you fall into the trap. The ICAI examiner is looking for a much deeper, more structured response. This gap between a generic answer and a technically precise one, that's where so many marks get lost. The master key to unlocking those extra marks is this one single word: assertions. So what is an assertion? It's basically a claim that management is making, whether they say it out loud or not, that's baked into every single number on those financial statements. So when they put inventory 5 crores, they aren't just giving you a number. They're making a bunch of claims about it. And our job as auditors is to test every single one of those claims. Now, to make things simple, we group these assertions into 2 main buckets, and you have to understand this difference. It's fundamental. First, for the income statement, we're auditing transactions and events that happened during the financial year. Think sales, purchases, expenses, things that occurred over time. Then, for the balance sheet, we're auditing account balances that exist at a single point in time, the very end of the period, like inventory or debtors on March 31st. Let's dig into each of these. First up, let's talk about the income statement. When we're looking at things like revenue or expenses, what we're really doing is verifying the story of the company's performance over the entire year. The very first assertion is occurrence. This is the most basic question of all. Did this sale actually happen? Was it a real transaction with a real customer, or is it a fictitious entry somebody cooked up to boost the sales numbers? Our first job is to confirm that these transactions are real and that they actually belong to the company we're auditing. Next up, we have completeness. Now, this is the flip side of occurrence. If occurrence is about what's there, completeness is about what's missing. Has the company recorded every single transaction that it was supposed to? For instance, did they conveniently forget to record some major expenses to make their profit look healthier? This is a huge risk area for auditors. Okay, now I need you to pay very close attention to this next one. Cutoff. I'm telling you, this is a major ICAI exam trap, and marks are lost here all the time. The question is simple. Are transactions recorded in the right accounting period? ICAI absolutely loves to give you scenarios where, say, goods are dispatched on March 30th, but the invoice is raised on April 2nd. Is that a sale for this year or for next year? Getting the cutoff wrong can seriously mess up the financial statements. And finally, for the income statement assertions, we've got measurement. This one is pretty straightforward. Is the amount recorded for the transaction correct? It's not enough that a sale happened. It has to be recorded at the right value. Did they calculate the discounts correctly? Is the GSD right? This is all about getting the numbers spot on. Okay, perfect. So we've covered the transactions that happened during the year. Now let's switch gears to the balance sheet and look at the assertions for those balances that exist right at the end of the year. For balance sheet items, our first assertion is existence. This is a lot like occurrence for transactions. If the books say there are 5 crores worth of inventory, our job is to go and verify that this inventory physically exists. We can't just trust the paperwork. We have to go see it, touch it, and count it for ourselves. And just like with transactions, completeness is absolutely critical for balances too. Have all assets, liabilities, and equity interests been recorded? The biggest fear for an auditor here is often the unrecorded liabilities. What if the company took out a big loan but never put it on the books? We're always hunting for what might be missing. Next, we have a really important one: valuation. For assets and liabilities, it's not just about whether they exist, but also if they're recorded at the right amount. Now, when it comes to inventory, the most crucial point, the one thing you must remember, comes from AS2. It has to be valued at cost or net realizable value, whichever is lower. I'm not kidding. ICAI tests this concept all the time. Know this rule inside and out. This brings us perfectly to our next assertion, rights and obligations. The question here is simple but so important. Does the company actually own the assets it's claiming? And are the liabilities listed really its own debts to pay? For example, just because inventory is sitting in their warehouse doesn't automatically mean they own it. It could be goods held on behalf of someone else. This is all about legal ownership and responsibility.
Okay, so that's a whole lot of theory, right? But the real question is, how do you actually use this stuff to score marks in your exam? Let's connect these concepts to a practical exam-style problem.
So here's a classic case study. You've got a fabric company. It has its own stock of yarn, but it also stores yarn for other mills that it just processes for them. It's all mixed together. Now, the auditor needs to make sure that when the company counts its year-end inventory, it doesn't accidentally include the yarn that belongs to those other mills. So which specific assertion is at risk here?
Let's break it down, just like you should in an exam. Step 1, what's the risk? The big risk is that the company might overstate its inventory by counting stock it doesn't actually own. Step 2, so which assertion does that hit? Well, since the whole issue is about ownership, the assertion at risk is rights and obligations. And then step 3, the money shot. What's the audit procedure? You'd write down things like physically separate the third-party stock, check the records to identify ownership, and get written confirmations from the other mills. You see that? Theory to risk to procedure. That is a full marks answer.
And finally, there's one last assertion that applies to absolutely everything, both P&L and balance sheet items, and that is presentation and disclosure. See, it's not enough for the numbers to be correct. They also have to be presented correctly as per the rules in Schedule 3. For instance, you can't just have one big number for inventory. You have to break it down into raw material, work in progress, and finished goods. You also have to disclose things like compliance with FEMA or PMLA. It's all about making the financial statements clear, transparent, and compliant. And speaking of disclosures, here is another critical exam point you absolutely must know. This is important. According to Accounting Standard 4, if a company proposes a dividend after the balance sheet date, say they decide on it on April 15th, it is not a liability in the March 31st balance sheet. It is simply a disclosure in the notes to accounts. This is a super common point of confusion, and ICAI loves to test it. Remember, it's a disclosure, not a liability.
So here it is, your final pre-exam checklist. For any income statement item you're asked about, you need to think occurrence, completeness, cutoff, and measurement. For any balance sheet item, your brain should go to existence, rights and obligations, completeness, and valuation. And of course, presentation and disclosure applies to everything. Seriously, take a screenshot of this. This is your master key. Using these exact words in your answers is how you signal to the examiner that you know exactly what you're talking about. What's that one sneaky disclosure requirement? You know, one of the newer ones that ICAI just loves to test, knowing that a ton of students probably just skimmed over it. The answer isn't always in the big numbers. Sometimes the real marks are hiding in the notes to accounts. Picture this. A company has a 2 crore cash credit facility, and it's secured by its stock and debtors. So how do you, as the auditor, not just verify this, but make absolutely sure it's disclosed properly? This question right here is exactly what we're going to unpack today. All right, first up, Section 1, the new regulatory disclosures. You're going to want to pay close attention here because these are recent, they're super relevant, and they are prime hunting ground for examiners. Honestly, missing these can cost you some of the easiest marks on the paper.
Let's break down 3 key disclosures that ICAI is all over right now. First, and this links right back to our opening problem, when a company takes a loan against current assets, you have to check if the quarterly statements they send to the bank actually match their own books of account. If they don't, you need to disclose a reconciliation. Huge point. Second, if a company gets declared a willful defaulter by a bank, well, you have to disclose the date and the details of that default. No hiding. And third, if there's a delay in registering charges with the ROC, the company has to disclose why. These are direct, gimme the facts kind of questions you just can't afford to miss. Okay, next up is a big one, and I promise you, ICAI absolutely loves asking about this. Fundroting. It sounds complicated, but it's simple. If a company gives money to someone, let's call them an intermediary, knowing full well that person is just going to pass it on to an ultimate beneficiary, then that whole money trail has to be disclosed. We're talking dates, amounts, everyone involved. The same thing applies in reverse if the company receives funds just to pass them on. And don't forget the final check. The company has to declare that it's complying with FEMA and the Prevention of Money Laundering Act. You have to know this one.
All right, let's switch gears and tackle our first major balance sheet item, trade receivables. We'll split this into 2 parts. First up, we're going to focus on 2 fundamental assertions, Existence? I mean, do these debtors even exist? And completeness. Have we recorded every single debtor that we should have?
So what are we talking about here? Super simple. Trade receivables, debtors, they're just the amounts your client is owed by its customers. An invoice goes out, a receivable is created. If it looks like the money's never coming, it gets written off as a bad debt. That's it. Now let's see how we audit them. Before you even dream of looking at a single number, your first job is to check the company's internal controls. You've got to check things like, is there a proper separation of duties? Are they only selling to customers who've been properly approved? Is there a solid system for chasing up overdue payments? You see, if the controls are strong, the risk is lower, and that changes your whole audit approach. Now, to check if debtors actually exist, the gold standard procedure is direct confirmation, which is covered in SA 505. This entire process is about one thing: auditor control. First, you get the okay for management. Then, and this is a classic spot where students lose marks, the auditor, not management, picks a sample. The client can prepare the letters, but you, the auditor, have to control mailing them out. And the replies, they must come directly back to you, the auditor. That control is what gives the evidence its power, and you have to mention that in your answer. Next up is completeness, and that brings us to cutoff testing. This is a favorite playground for ICI. Think about it. How can a company easily inflate its profits? By recording sales in March for goods that didn't actually ship until April. So what do? You check the last few invoices of the year and the first few of the next year, and you match them to the dispatch documents. And keep an eye out for a sudden spike in sales returns right after the year end. It's a huge red flag for fake sales that were booked just to hit a target. Okay, so we're not done with trade receivables just yet. Let's get into part 2. We've confirmed that debtors exist, and the list is complete. But are they valued correctly? And are they presented the right way in the financials? Let's figure out how to check that. Valuation is all about one word: recoverability. See, it's one thing to say a debtor owes you a lakh of rupees. It's another thing entirely to actually get that money in the bank. Your key tool here is the debtor aging report. You'll dig through it looking for those really old balances. And here's a really powerful audit procedure. Check for collections after the balance sheet date. If a debtor who owed money on March 31st paid up in April, that's fantastic evidence that the debt was actually good. And finally, for receivables, let's talk presentation. Now this, you guys, is non-negotiable. You have to know this. Schedule 3 of the Companies Act makes this specific aging format mandatory. You need to know this table inside and out, how it breaks down receivables by age, and whether they are undisputed or disputed, good or doubtful. ICAI could easily give you a practical problem and ask you to create this schedule. So please make sure you know this format by heart. Okay, moving on to section 4, cash and bank. Now, you know what they say about cash, right? It's the most liquid asset, which means it also has a super high risk of going missing. So our professional skepticism, it needs to be cranked up to the max for this one. So when you're auditing cash on hand, you have to be there. Physically, no exceptions. You need to be on high alert because your main job is to make sure every single rupee that's recorded in the books is physically sitting right there in that cash box. Let's look at the exact procedures to make that happen. Here are the procedures you need to know for the exam. If a company has cash in more than one place, like a main cashier and a separate petty cash box, you have to count them all at the same time. This is a classic audit technique to stop someone from sneakily moving cash from one box to another to cover up a shortage. Also, make sure the cashier is present for the count and signs off on your sheet. And look out for any IOUs or random chits in the cash box. Those aren't cash. When it comes to the bank balance, your best friend is the BRS, the bank reconciliation statement. Go through it carefully and question any big, old, or weird-looking items. All right, let's roll up our sleeves for section 5, inventory. This is a biggie, covering everything from physically counting boxes on the warehouse floor to the nitty-gritty calculations of how it's valued on the balance sheet. Okay, first things first, existence. As per SA 501, you, the auditor, have to be there for the physical count if it's at all possible. This isn't optional. You're there to observe their process, do some test counts of your own, and perform those all-important cutoff checks. But what if the inventory isn't on site? What if it's at a third-party warehouse? Simple. You get a direct confirmation from them, pretty much the same way you do for debtors. Now for valuation. The golden rule you have to remember is cost or net realizable value, NRV, whichever is lower. For finished goods, you'll look at the cost sheets and compare that to what they can actually sell it for. Now, WIP, or work in progress, that's a bit more of a puzzle, right? You need to figure out how complete it is. Check the costs that have gone into it, material, labor, and really importantly, make sure that the way they're applying overheads is reasonable. All right, we're on the home stretch. Our final section, auditing PPE and intangibles. These are the big ticket, long-term assets that really form the backbone of a company's operations. So where do you even begin with PPE? It always starts with the PPE movement schedule, or the fixed asset register. It's a really simple reconciliation. You take the opening balance, you add any additions during the year, subtract any deletions, and that should equal your closing balance. Your job as the auditor is to check every single piece of that puzzle. For additions, you'll vouch them against invoices and check for proper sign-offs. And here is a classic trap that ICAI loves to set in exams. You have to make sure that regular repair expenses, which are revenue in nature, haven't been incorrectly capitalized to inflate assets. For deletions, you'll check the sale approvals, recalculate the profit or loss on the sale, and make sure the asset is completely wiped from the books. And the process for intangibles? It's pretty much the same idea. The audit of financial statement items. We're going to break this down exactly the way you need to think about it for your exams. Okay, let me ask you something. You're in the exam hall, you see an intangible asset on the balance sheet. Let's say computer software. You check, yep, amortization has been charged. You put a tick next to it and feel good. But hang on, that's exactly where marks are lost. The real question, the one that the examiner is actually testing you on, is how it's being amortized. Is the method right? Does it actually reflect how the asset is being used up? That's the detail that makes all the difference.
So for the next few minutes, I want you to put on your auditor hat. The client's balance sheet and P&L are sitting right in front of you. Our mission? To go through the trickiest line items one by one and absolutely master the audit procedures. We're going to find all those little traps that ICI loves to set. You ready? Let's get into it.
All right, Section 1, Intangible Assets. Look, anyone can check if an asset exists on paper. That's the easy part. The real marks, where you can really show what you know, are in verifying 3 key assertions: valuation, rights and obligations, and of course, disclosure. So let's break down valuation. First things first, you have to check that amortization is being charged on all intangibles, no exceptions. Second, just like we said, you have to question the method. Is it straight line? Is it written down value? Does it actually make sense for that asset? And third, and this is a classic ICI point, so listen up, you must verify that management has done an impairment assessment as per AS 28. That is a non-negotiable check. For rights and obligations, it's simple but vital. Check that the purchase invoices and legal contracts are in the company's name. They have to actually own it. Now, when it comes to disclosure, Schedule 3 gets very specific. It's not enough to just lump everything under intangible assets. You have to classify them into these exact buckets: goodwill, brands, software, mastheads, mining rights, copyrights, all the way down to licenses, and then a catch-all others category. Seriously, take a mental screenshot of this list. It's perfect material for MCQs.
And it doesn't stop there. For every single class of intangible asset, a full reconciliation schedule is mandatory. You know the drill. What was the opening gross and net amount? What was added? What was sold? Anything acquired through a business combination? You need to show the entire movement. Pay special attention to any revaluation changes, especially if they impact more than 10% of the net carrying value. And of course, you track other adjustments and the related depreciation and impairment. This entire schedule is a must-have. And check this out, another super specific disclosure format. This one's for any intangible assets that are still under development. If a project is running late or has gone over budget, you have to present this exact schedule, showing the expected completion timeline. And look at that note at the bottom. Any projects that have been put on hold, they need to be disclosed separately. Trust me, ICII loves to test you on whether you know these specific formats.
All right, let's flip over to the other side of the balance sheet. Section 2, Trade Payables. Now think about this. With assets, our big worry is usually overstatement, right? But with liabilities, like payables, the risk is the complete opposite. It's understatement. Companies trying to hide liabilities to look healthier. That's the trap. So our key word here, the one to burn into your brain, is completeness. And the number one area where completeness gets tested is cutoff procedures. It sounds so simple, but I can't tell you how many marks are lost right here. The rule is crystal clear. If the goods were received before the year end, say on March 31st, the liability must be booked in the current year, period. If the goods show up on April 1st, it doesn't matter what the invoice says, that's a liability for the next year. So as an auditor, you have to check the goods received notes from the last few days of March and the first few days of April. It's that critical. To really nail completeness, you have to dig deeper. Review the expense vouchers paid right after the year end.
An electricity bill paid in April is probably for March's usage, right? That's a current year liability. Also, check advances from customers. Any disputes could signal a potential liability. And then there's the big one, statutory dues. GST, TDS, PF. This is crucial. Do some reasonability checks. For instance, calculate the rough GST liability based on sales and see if it matches what they provided for. And always verify the payment chalons from after the year end. Remember, this links directly to your CARO 2020 reporting.
For valuation, yeah, you should check their policy for writing back old creditor balances. But honestly, the real exam hotspot here, and I mean major hotspot, is MSME disclosures. This is extremely important. You must verify that the company has disclosed the principal and interest still outstanding to their MSME vendors, how much interest they paid during the year, and, this is the kicker, any further interest that's going to be disallowed as an expense under the MSMED Act. This is a guaranteed question area.
And speaking of disclosures, here's the exact format Schedule 3 demands for the trade payables aging. Take a good look. It's not just a simple aging report. Notice the breakdown. You have to separate MSMEs from others, and then you have to separately show any disputed amounts for both MSMEs and for others. You need to know this layout cold.
Okay, moving on. Section 3, Other Liabilities and Provisions. Think of this as the miscellaneous bucket, but don't let that fool you. These are exactly the kind of items that ICAI loves to throw in a short note or a tricky practical question just to see if you've done your homework. So in this category, you have your usual suspects: accrued interest, income received in advance, unpaid dividends. But the one you need to circle in red is share application money. This is a classic ICAI twist alert. Schedule 3 has very specific rules. You have to disclose if the company has enough authorized capital, and you need to explain why any money is pending beyond the allotment period. And here's the key part. Any amount that is refundable, like from an oversubscription, has to be shown under other current liabilities. It does not go under equity. That's a common mistake.
Let's move on to Section 4, Loans, Advances, and Contingencies. So here, we're looking at assets like loans the company has given out, and we're also peering into the future to identify potential liabilities that aren't even on the balance sheet yet. When you're auditing loans and advances that the company has given, you need to laser focus on a couple of things. First, for any loans to related parties, you've got two key checks. Was the loan properly authorized, and was it done at an arm's length price? Super important. Second, for balances with statutory authorities like GST input credit, your go-to procedure is a reasonability check. Just apply the relevant GST rates to their purchases and see if the input credit balance they're claiming makes sense. If it's way off, you know you need to investigate. Now for contingent liabilities, your main job is to ensure proper disclosure. The standard lays out 5 key things you need to verify for each class of contingency. 1. A brief description of what it is. 2. An estimate of the financial impact. 3. An indication of any uncertainties about the outflow of cash. 4. The possibility of any reimbursement. And 5. If it's just not practical to estimate the financial effect, that fact must be stated. Memorize these 5 points. They are pure gold for a theory question. All right, let's jump over to the Statement of Profit and Loss. Section 5, Auditing Revenue and Other Income. The top line of the P&L is a massive risk area, so we have to be incredibly thorough here. To verify revenue, we use a technique called examination in depth. You basically pick a few sales transactions and you trace them from start to finish, from the sales order to the dispatch documents to the invoice to the entry in receivables, and finally to the payment hitting the bank. It confirms the entire cycle is working. For disclosure, Schedule 3 requires you to show gross revenue and then excise duty as a deduction. You also have to separately disclose revenue from selling products versus providing services and other things like brokerage or discounts. For other income, each item has its own verification procedure. For interest income, you should recalculate it based on the agreements. And here's a great practical step. Reconcile it with the company's Form 26AS. For dividend income, the key is timing. It can only be recognized when the right to receive is established. And for any gain or loss on the sale of investments, recognition happens only on the transfer of title, and it's simply the difference between the sale proceeds and the carrying amount. And finally, Section 6. We're going to cover some recent and very important regulatory disclosures that Schedule 3 now requires. These are the final checks that can absolutely make or break your audit opinion. This is a huge exam alert, so pay close attention. First, Benami property. If there are any proceedings against the company under the Benami Transactions Act, they have to disclose all the details: the property, the amount, the beneficiaries, and the company's side of the story. Second, undisclosed income.
If the company surrendered income during a tax search, you, as the auditor, have a direct reporting responsibility. You have to state whether that previously unrecorded income and its related assets have now been properly recorded in the books of account. This is a big deal.
This is your ultimate revision session for auditing expenses and disclosures. We are going to cut right through the theory and focus only on what you absolutely need to know to crush it in your ICAI exams.
Imagine this. A company buys a shiny new machine. It's installed, it's tested, it's sitting on the factory floor, ready to go in April. But, there are no customer orders. So the machine just sits there gathering dust until October when they finally switch it on and start production. The accountant starts charging depreciation from October. Now the question for you is that correct? Have a quick think.
If you were thinking October, I'm sorry to say you've just walked straight into the ICAI's favorite trap. This is a huge deal, and marks are lost here all the time. So listen up. The critical rule is this: depreciation begins when the asset is available for use, not when you actually start using it. So the correct answer was April. This is a fundamental concept we're going to hammer home today. But first, let's quickly see what's on the agenda.
Okay, let's dive into Section 1, the Big Three. Why are they the Big Three? Because for most companies, purchases, employee benefits, and depreciation are the largest, most significant expenses. So naturally, as auditors, we pay a ton of attention to them. Let's kick things off with purchases. When you're auditing purchases, your main goal is to make sure everything's been recorded and in the right period. The cutoff procedure is absolutely non-negotiable. You've got to check those last few goods receipt notes, the GRNs, of the year to make sure sales from next year haven't crept in. For goods that are still on a truck at year-end, you have to figure out who has the risk and reward to see if it belongs on the books. And always get a written representation from management. Think of it as your safety net, confirming they've recorded everything. Finally, you have to nail the Schedule 3 disclosures for stock in trade, inventory changes, and any deals with related parties.
Now here is a massive exam tip, seriously. Don't just be a tick and bash auditor. Use your brain. Use analytical procedures to get the big picture. You're like a detective looking for clues. Compare this year's raw material consumption to last year's. Does it make sense with their production numbers? Look at the stock mix. Has the percentage of raw material in their total stock suddenly jumped or dropped? That could be a red flag. And of course, ratio analysis. Comparing creditor and stock turnover ratios can tell you a story about how fast they're paying suppliers and selling goods. This is how you spot problems before you even look at a single invoice.
Let's move on to our second big expense, employee benefits. And remember, this is way more than just salaries. It's the whole shebang: gratuity, provident fund, leave encashment, even the costs of hiring and training people. For a ton of companies, especially in the IT or service industry, this is the single biggest expense they have. And what does that mean for you as an auditor? It means it's a high-risk area.
So how do you audit it? Easy. Just follow this 3-step playbook. First, you test the company's internal controls. Are they properly tracking attendance? Is the employee master data safe from random changes? Who has the power to approve the final payroll? If the controls are strong, you can do less detailed testing later. Step 2, you do some sample vouching. Pick a few employees and trace everything: their appointment letter, attendance, salary slips. And finally, Step 3, you bring out the big guns: substantive analytics. Compare the payroll cost month to month. Are there any weird spikes? And absolutely verify that all the statutory deductions, like PF, have been calculated and paid over to the government correctly. And now for our third major expense, depreciation and amortization. Here is your mental checklist. When you're looking at depreciation, these are the questions you should be asking. 1. Is their policy okay? Does it follow the Companies Act and the accounting standards? And are they using it consistently year after year? 2. Are the calculations themselves actually correct? You'd be surprised how often there are simple math errors. Have they remembered to deduct the residual value? 3. Is the charge even valid and for the right period? 4. And this is a key one people miss. Are they depreciating significant parts of an asset separately? Think of an airplane. The engine has a different life than the body. And finally, don't forget the intangibles. Things like patents and goodwill need to be amortized properly.
And boom, here we are, right back to the point we started with. I'm showing you this again because it is that important. You need to burn this sentence into your brain. Depreciation starts when the asset is available for use. That means it's in the right place, in the right condition, and ready to work the way management wants it to. It has nothing to do with when they flip the on switch. Remembering this one line could easily save you 5 marks in the exam.
Okay, here's a slightly more advanced point, the kind of thing that can really make you stand out. What happens if an asset has been revalued upwards? Well, now you've got extra depreciation on that increased amount.
As an auditor, you have to check that this extra depreciation is charged to the P&L, but also, and this is the key part, that an equivalent amount is transferred from the revaluation reserve over to retained earnings. It's a specific accounting entry, and you need to make sure it's been done. Okay, we've wrestled with the big three. Now let's shift gears. It's time for a rapid-fire round on a couple of other key expenses. We're going to cover these quickly, but make sure you know the main points. First up, we've got insurance and legal and professional fees.
For insurance, the key thing is all about timing. You need to get a summary of all their insurance policies and check the classification. How much of that premium is a prepaid asset for next year, and how much is the actual expense for this year? For legal and professional fees, get a summary by consultant. Check that the monthly retainers have been booked for all 12 months. And for any big one-off bills, just vouch a sample to make sure they're legitimate and have proper support. Simple checks, easy marks.
All right, everyone, I need you to lean in and pay close attention here. This next section on Schedule 3 disclosures is basically a goldmine for easy marks if you just know the rules. So many students focus on the complex audit procedures and then forget these basic presentation points. Don't let that be you. Let's look at two very modern and highly testable disclosures. First, CSR, or Corporate Social Responsibility. If the rules apply to the company, they have to spell everything out: how much they were supposed to spend, how much they actually spent, and if there's a shortfall, they have to explain why. And they have to disclose any CSR deals with related parties. Second, crypto. Yep, it's in Schedule 3. If a company has been trading or investing in crypto, they have to disclose the profit or loss they made, how much crypto they're holding at the year-end, and any advances they've received from other people for trading.
Next up, the aging schedule for trade receivables. This is mandatory. See, a single number for debtors doesn't really tell you the full story, does it? The company has to break it down. They need to show how much is outstanding for less than 6 months versus more than 6 months, and, crucially, they have to split out the undisputed amounts from the amounts that are in a dispute. This gives anyone reading the financials a much clearer picture of how likely they are to actually collect this money.
And it's the same logic for Capital Work in Progress, or CWIP. This disclosure is designed to stop companies from hiding projects that have been stalled for years under one big number. They have to provide an aging schedule showing how long these assets have been under construction, less than a year, 1 to 2 years, and so on. And they also have to separately show any projects that have been put on hold.
But wait, there's more. It doesn't stop there. If a CWIP project is running behind schedule or has gone over budget, the company has to provide yet another schedule. This time, they have to tell us when they actually expect to finish these overdue projects. It's all about transparency.
Okay, let's switch it up again. Section 4 is our vouching quick round. You know those descriptive questions in the exam that start with, how will you vouch, or how will you verify? Well, this section is for exactly those questions.
Let's lock in 3 common items. First, goods on consignment. You're going to want to check the account sales report from the person selling the goods for you, make sure the commission and expenses match your agreement, and, super important, make sure the closing stock they're holding is valued correctly. Second, capital subsidy. Review the letter from the government or whoever gave the subsidy, trace the money into the bank account, and make sure it's accounted for properly as per AS 12. And finally, sale of scrap. Here you'll first check their internal controls for how they handle scrap, then vouch the sales to invoices and just check that the rates they're getting seem reasonable.
And here we are, in the home stretch. Our final section is all about those core concepts that are absolute gold for your MCQs. If you really get these fundamentals, you'll be able to answer so many different types of questions with confidence. Okay, the securities premium account. This is a classic, a total favorite of the ICII. They love to give you 4 options and ask which one is not a permitted use. Well, there are only 5 things you can use this money for, under Section 52. They are issuing bonus shares, writing off preliminary expenses, writing off share issue expenses, paying a premium when you redeem shares or debentures, and for a share buyback. That's it, 5 uses. Memorize this list. Anything not on this list is a trap.
Finally, let's make financial statement assertions super simple. When a company puts a number in its financial statements, it's not just a number. It's a set of promises, or assertions. Let's use this building example. If the balance sheet says building 100 lock, management is asserting a few things. First, existence, that the building is real and actually exists. Second, rights and obligations, that the company actually owns or has the rights to that building. Third, valuation, that 100 lock is the correct value according to accounting rules. And fourth, completeness, that this 100 lock figure includes all the buildings the company owns. Every single audit test you do is designed to check one or more of these assertions.